Well, holy flippity flip flop flapping smokes, everyone. People have no idea how bad 2023 is going to be. Right now, we have some hopium in the markets that things aren't going to be that bad. But people, I've got some huge news, some huge facts and data to show you that things are going from bad to worse. And again, this is just people having wishful thinking. We normally see this at the end of the year. They call it the Santa Claus rally, and hoping that all the problems when the calendar, switches from the 31st of December to the 1st of January, that all those problems are just going to go away. Which, newsflash people, they aren't. Now, like I've been told you in my last video, I've been sick the past 3-4 days. But I'm feeling much better now. But what that means is we have a lot to catch up on, everyone. So this is going to be an action-packed episode, full of news, full of data, and some big things have happened while I've been away. So you know what time it is, everyone. Let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, this is what's been causing all the hopium in the markets right now, everyone. Fed Chair Powell says smaller interest rate hikes could start in December. Well, everyone, this is no surprise. The Federal Reserve has been doing big rate hike increases, and while they've been slow to the party, they are now catching up. They were doing small 25 basis point hikes and 50. Now they've done 3 to 4 75 basis point hikes, and they've been telling us for months that eventually they will slow. But what a lot of investors are taking this as is they're saying, well, look, now the Federal Reserve's pivoting. No, this has been part of the Federal Reserve's plan all along to go from 75 basis point hikes to 50 and then 25. But the destination of what interest rates are going to go to is going to be the same. That is 5% to 5.25%. But what we're in right now is a bear market rally, and the market is looking for any excuse to go higher. And like I've been saying, the Federal Reserve has been lifting interest rates so fast, we haven't even felt the full effects because they normally have a lag of about 6 to 12 months. But people, we are starting to get some data now to show these high interest rates are having a big effect on the economy, and it's only going to get worse in 2023. So let's dig a bit deeper. So a huge economic indicator of run, and this is a leading indicator. US composite PMI suggests the economy is on the verge of recession. So look at this chart, everyone. This is the S&P Global Flash US PMI Composite Output Index. And we can see here, whenever it drops below 50, it goes into the negative. So we can see here 0, and it is now dropping into the negative. So Flash US PMI, this is a Purchasers Manager Index. So the Flash US Purchasers Manager Index Composite Output Index is at 46.3. In October, it was 48.2. So this is a 3-month low. The Flash US Services Business Activity Index is at 46.1. In October, it was 47.8. So this is a 3-month low. But listen to this. The Flash US Manufacturing Output Index is at 47.2. In October, it was 50.7. That's a 30-month low. And Flash US Manufacturing PMI is at 47.6. In October, it was 50.4. Again, this is another 30-month low. Is they've taken on too much goods. Their inventory has been too high. We've been seeing this with the sales of Black Friday. Even besides Black Friday, there's been huge sales. They've been trying to get rid of inventory, and demand is collapsing. Because I'll get into a moment how the US personal savings rate has just fallen even lower, and it could actually eventually hit 0, which is crazy. Consumer credit card debt is at all-time highs. But what this is saying is this is a leading indicator that there's going to be much weaker demand ahead, and the manufacturers and the producers aren't going to be producing as much, and people aren't going to be consuming as much. But that's just the tip of the iceberg. There's a lot more going on, people. Look at this. The US wants the EU to be strict with China, but Europe can't afford it. So this is another big risk for the global economy in 2023. The geopolitical situation across the globe is getting worse. Countries are getting more confrontational. The economic warfare with China and the West is getting worse and worse, and this is going to have severe consequences for the global economy in 2023. Right now, we're seeing the protests in China. That means China's not going to be producing as much goods, and it also means that companies are going to pull the manufacturing out of China because they keep on going to lockdowns, or even if they don't go into lockdown, their workers have had enough from these terrible working conditions and they're demanding more and more pay, and that's going to lead to the end of globalization or peak globalization, and it's going to make inflation next year get even worse as companies have to look for more expensive alternatives or bring back manufacturing onshore. While the European Union has dubbed China as a strategic rival on different occasions, it is pursuing a different approach from the US. Data from Europe's Statistics Office showed that China was the third largest buyer of European goods and the most important market for the imported EU products in 2021. The importance of China as a market for Europe becomes even more relevant at a time when its economy is struggling from Russian invasion of Ukraine. So that's right, everyone. China has been the factory of the world, but now they're also becoming a large purchaser of global goods, and they were the third largest buyer of European goods. So Europe simply can't afford to lose China as a trading partner. But we got some more news and more data today on what's going on in the jobs market, and this far bet expectations, and that means there's going to be a much harder path ahead for the Federal Reserve, and it means interest rates are going to have to go much higher. Look at this, everyone. The Fed's path to a Goldilocks economy just got a little more complicated. Now, what we saw a couple of days ago was core inflation came in lower than expected, but now with the jobs numbers coming in better than expected, and also wages are coming in higher than expected, this is complicating the picture. On one side of the story, they're saying that inflation is starting to go down, but if wages keep on going higher, this eventually is going to lead to more inflation in 2023. And again, like I said, it all depends on what happens to oil in 2023 as well. So payrolls grew by 263,000 in November, well ahead of the 2000 Dow Jones estimate. Wages also rose 0.6% on the month, double the estimate, while the 12-month average hourly earnings accelerated 5.1% above the 4.6% forecast. Now, again, people, while they're saying this is so great, wages are going up 5%, remember, inflation is 7.7%. So in real terms, people's wages are going backwards. And that's why we're seeing the US personal savings rate plummet and why we're seeing credit card debt accelerate. Because in real terms, people's living standards are getting worse and worse. But people, I do expect this to change, and I do expect we're going to see big job cuts in 2023, and we're already starting to see the early signs of it. Look at this, job cuts surged 127% in November as companies brace for an economic downturn. Not only that, Wells Fargo cuts hundreds more mortgage employees on industry slowdown. So that's right, everyone, why the jobs report is looking good now. Remember, this is lagging data. We're also in a hiring season. A lot of companies will be hiring for the holidays. They're going to be hiring a lot of short-term employees, a lot of casual, part-time employees. But what I'm expecting is a lot of these employees are only short-term or temporary employees, and they're going to be let go in the early part of 2023 when companies realize this holiday sales season wasn't great. Especially like what we saw with Black Friday. A lot of people said they went to shops on Black Friday and there wasn't many people shopping at all. Even if there was people in the malls, they weren't really buying much at all. And this is because the consumer has been sucked dry. Now, something else that's also going to have a big effect on the economy is the housing market. People have turned their houses into credit cards, have been refinancing, taking their equity out of their homes over the past 10 years. If they've gotten into debt or they've gotten into any problems, they've just been able to either sell their house or refinance their house, get lower and lower interest rates to keep up their standard of living and their high spending. But they're not going to be able to do that this time. We got more data that shows the housing market is slowing and house prices are falling. So look at this, US home prices tumbled in September for a third straight month. So prices slid 1% nationally in September from August, the third consecutive monthly decline. The S&P 500 CoreLogic Case-Shiller Index showed on Tuesday. On an annual basis, the index climbed 10.6% in September, down from 12.9% rate the previous month. So this proves, like I've been warning about everyone, the housing market is starting to fall. Now again, you may think, well, dropping 1%, that's not much at all. But this starts to compound, everyone. And remember, the housing market, it's not like the stock market. It doesn't just crash in 1, 2, 3 months. The housing market could go on a downturn over 24 months. And if it just drops 1% every month, well, we could see prices down anywhere between 20 or 30%. And what this causes, this is going to cause a negative wealth effect. Normally when assets go up, people have something called the wealth effect. They feel wealthier. They're more likely to go out and spend. But when the asset prices start to crash, well, they're going to tighten their belts, they're going to tighten their spending. Now we're seeing stocks crash, so that's going to cause a negative wealth effect. We're seeing all the crypto bros, they've lost their money. They're now applying to work at McDonald's, so their wages are going down, their income's going down. And the biggest asset for the middle class is real estate. So once their homes start losing value, or they can't refinance their mortgage anymore because their mortgage rate will go from 3% to 7%, well, this means there's going to be nothing to stop this downturn that's coming. Because look at this, everyone. US savings rate falls to a 17-year low amid relentless inflation. And look how bad it's gotten, everyone. Look, it is the lowest since 2005, and it is worse than 2008. And look at this. Credit card balances jump 15%, highest annual leap in over 20 years as Americans fall deeper and deeper in debt. I've been warning about people, this is a recipe for disaster, but the party is all going to end in 2023, and that is when the US consumer is going to have to pay the bill. Now, again, we've got more warnings from big banks and institutions to say that the bear market is not over and there is going to be more declines coming. Look at this wild ride. Morgan Stanley's Mike Wilson predicts double-digit percentage drops will hit stocks in early 2023. So what exactly is going to trigger this decline, everyone? Lee warns next year corporate America is getting ready to unleash downward earnings revisions that will plummet stocks. So that's right, everyone. It's very, very simple. These companies, if consumers have no savings and they're in record debt, they're not going to be able to spend. We're seeing big layoffs if people aren't earning income, well, they're not going to be able to spend. And a lot of investors, they've been overpaying for stocks. They still are overvalued, and they're saying, well, the earnings are going to be so high next year, or the growth is so enormous, or the growth potential is so good. Eventually, the earnings will catch up. Well, no, earnings have been getting worse every quarter, and they're only going to get even worse in 2023. Well, he believes it could drop 24% from Tuesday's close in early 2023. You should expect the S&P 500 between 3,000 and 3,300 sometime in probably the first 4 months of the year, he said. He said that's when we think the deceleration or revisions on the earnings side will kind of reach its crescendo, and he believes the pain will be widespread. Most of the damage will happen in the bigger companies, not just tech, by the way. It could be consumer, it could be industrial. Wilson said when those stocks had a tough time in October, the money went into these areas, so part of that rally has been driven just because repositioning from the money moving. And I agree, everyone. I've been calling for a decline of around 35% from the S&P 500 peak to where I think the rough bottom will be. It could be anywhere between 30% and 40%, but the average bear market decline has been around 34% over the past 17 bear markets. Now, something that's also been contributing massive to this rally is the dollar actually crashing. Look at this, everyone. The US DXY index has been absolutely plummeting. It hit a high of around 114, and now it's plummeted all the way down to 104. Now, when the dollar crashes, all assets priced in the dollar rise, and we are seeing that right now with gold and silver. I've been telling everyone, if you want to hedge against this inflation, if you want to hedge against this crisis coming, a good way to buy insurance and to hedge and protect yourself is to invest in gold and silver. And while gold and silver has been on a huge tear lately. Look at this. Gold is all the way back above 1,800 right now at $1,811. But silver has been on an even bigger tear. It's now $23, up 2.2%. So everyone, I know that was a lot to take in. I know what you're thinking. What does all this economic jargon mean for you in simple terms? What this means is, everyone, while things haven't been that bad yet, things are only going to get much worse in 2023. People still had a bit of that money that was printed left over from 2020 and 2021. People still had some savings left over. People still had some borrowing power left over. But now that borrowing power has been maxed out, the savings has been maxed out, companies' earnings are going to plummet next year. The geopolitical situation is getting worse. The political situation in the US is getting worse. Both sides, the left or right, the tensions there are brewing. Things are going to hit a climax, I think, in 2023, and there's going to be much more pain in the markets coming ahead. So you're definitely going to want to prepare right now, like I've been warning about. Get an emergency fund, pay off high interest debt, and a way you want to protect yourself, not financial advice. What I'm doing is by investing in gold and silver, and you won't have these huge declines like you see in Bitcoin, and that is a real store of value, and that has been the real money for the past 5,000 years. But everyone, what do you think all about this? We definitely still got a lot more to catch up on to. I'll be pumping out more videos now that I'm feeling better. So again, what do you think? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.